What if I told you there's an ETF out there claiming yields so massive, it almost feels like cheating the system? But wait, does this infinite money glitch come with a hidden catch? Today, we're diving into M.S.T.Y, the YieldMax MicroStrategy Option Income ETF, which flaunts an eye-popping 168% distribution rate. Sounds too good to be true, right? Stick around as we break down how this ETF actually works, what's driving those sky-high payouts, and, most importantly, whether it's the golden goose for your portfolio or a ticking time bomb. Trust me, you don't want to miss this one. By the end of this video, you'll know exactly how MSTY generates its income, the risks involved with its unique strategy, and whether it deserves a spot in your portfolio. Plus, we'll answer the million-dollar question: can this ETF truly deliver financial freedom? Or is it a high-risk gamble that could leave you empty-handed? Let's dive in. But first, welcome to the High Dividend Explorer, everyone. Here, we explore the best high-dividend ETFs and stocks to help you achieve financial freedom and retire way before 65. If you're new to the channel, our goal is to empower you with the knowledge and tools to build income-focused portfolios that take back control of your time. If you enjoy this content and want more tips, comparisons, and reviews, make sure to like and subscribe. Your support helps us keep bringing you great insights. MSTY, or the YieldMax MicroStrategy Option Income Strategy ETF, is no ordinary fund. It doesn't invest solely in MicroStrategy stock, despite being tied to its performance. Instead, MSTY uses a call writing strategy. Here's what that means. The fund generates income by selling call options on MSTR stock. When you sell a call, you essentially collect a premium in exchange for capping your upside if the stock price rises too high. MSTY's main goal? To turn these option premiums into consistent monthly distributions for its investors. But here's the kicker. MSTY's strategy caps your potential gains on MSTR shares. And if the underlying stock crashes, you're still exposed to losses that the ETF's income might not fully offset. So while the 168% distribution rate sounds jaw-dropping, there's no free lunch here. The risks are real. The secret sauce behind MSTY's yield is its derivatives-driven strategy. Each month, the fund writes call options on MSTR, earning premiums that make up the bulk of its distributions. Now, here's where it gets tricky. These distributions can include a mix of ordinary income, capital gains, and sometimes even return of capital. That last part, return of capital, means you could be getting paid back part of your own investment, which lowers the ETF's net asset value, or NAV, over time. And let's not forget, MSTY's 30-day CC yield is listed at 0.0%. Why? Because the fund relies entirely on option premiums, not traditional interest or dividends. This makes MSTY a high-risk, high-reward play for income seekers. Let's talk numbers. MSTY's most recent distribution was a whopping $4.42 per share in November, adding up to that eye-popping annualized yield of 168%. But hold on, these payouts aren't guaranteed. If MSTR's stock price stagnates or tanks, MSTY's income-generating potential could dry up quickly. Also, remember that the ETF's performance doesn't necessarily track MSTR's. Even if MSTR stock rallies, MSTY's gains are capped due to the call writing strategy. This means you're giving up growth potential in exchange for income, something to carefully weigh depending on your financial goals. Now let's get into the risks, because MSTY is far from a set-it-and-forget-it ETF. Single issuer risk. MSTY is heavily tied to MicroStrategy stock, which is famously volatile. This concentration means the ETF's performance can swing wildly based on MSTR's price movements. Price participation risk. As I mentioned earlier, MSTY's strategy caps your upside. If MSTR rockets upward, you'll only see limited gains while still being exposed to the downside. Derivatives risk. MSTY relies on options, which can introduce counterparty risk and liquidity challenges. Return of capital. Over time, consistent return of capital distributions could erode the ETF's NAV, potentially leading to long-term losses. In short, MSTY is not for the faint of heart. It's a tactical play for investors who understand the trade-offs and are willing to take on considerable risk in pursuit of high income. Now let's move on to head-to-head comparison between MSTY and MSTR, focusing on their total returns with and without dividends reinvested. The comparison will start from February 22nd, 2024, when the fund was created. With dividends reinvested, MSTY turned a $10,000 investment into close to $32,000 in just 0.76 years, with an annualized gain of 283% and a total return of 217%. MSTR significantly outperformed, turning the same $10,000 into $54,520 in the same period, achieving an annualized gain of 582% and a total return of 445%. Without dividends reinvested, Without reinvested dividends, MSTY's total return dropped to 154%, growing the $10,000 to $25,457 with an annualized gain of 202%. MSTR remained unchanged since it doesn't distribute dividends, keeping its total return at 445%, growing the $10,000 to $54,520 with an annualized gain of 582%. Clearly, MSTR dominated in terms of total return, thanks to its growth-oriented approach and reinvestment of earnings. However, for income-focused investors, MSTY offers a compelling mix of high dividend payouts and steady capital appreciation. So who should consider investing in MSTY? If you're an income-focused investor who's comfortable with high risk and understands the nuances of options-based ETFs, MSTY might deserve a closer look. It's a unique way to generate outsized income from a single stock's volatility. But if you're looking for long-term growth, broad diversification, or a stable income source, MSTY is probably not the right fit. The fund's strategy is highly speculative and better suited as a small, tactical allocation within a well-balanced portfolio. Now that you know how MSTY works, the risks involved, and whether it's the right fit for your portfolio, what do you think? Does this ETF scream opportunity, or are the risks just too high? Let me know in the comments below. And hey, if you found value in this video, don't forget to hit that like button and subscribe to High Dividend Explorer for more deep dives into high-income ETFs. Let us know in the comments which ETF or high dividend investment you'd like us to analyze next. Your feedback could inspire our upcoming videos. Together, we'll explore the best paths to financial freedom and reclaiming your time. Until next time, happy investing.